Hi, this is David Dickens, and today we're going to go through two different listener questions. One about a gentleman who wants to quit his corporate job and start a business, and another about a retiree who's living comfortably on their Social Security and pension, but just figured out that his pension doesn't adjust for inflation. So we'll talk through those. Hopefully there's something in here just for you. I'll go get Walter, and we'll get started.
Hey, thanks for joining us for another edition of Cover Your Assets, KC. Walter Storholt here with David Dickens, the president and wealth advisor of Creative One Advisors Group. You can find us online at creativeoneadvisorsgroup.com. And as David teased, we've got two listener questions we're going to dive into on today's program. Those will be coming up in a moment. But first, David, I hope you had a great Labor Day weekend and your September's off to a good start.
Well, it is. I got to admit, I'm kind of nervous about a couple things. And I don't share a lot of personal information on this podcast over the years, but I got a couple things that are really on my mind.
Okay.
One is my fantasy football league, family league drafts tonight, and I am the reigning champion. And I got to admit, I'm a little nervous about defending the crown. So
who to pick and all that.
Oh my gosh, it is stressful. So that's at 8 p.m. tonight. So I just want to have you keep me in your thoughts on that deal.
Can you clue us in? Who's going to be one of your top picks? Are you going Mahomes right off the board or?
Oh, no. My league, unless you are just so keyed into one quarterback usually happens in the fourth round. You're kind of trying to find a couple good wide receivers and a couple good running backs. So I've got those in mind. I'm certainly not going to share them with the audience here because one of these, well, it wouldn't be released by then. But anyway, yeah. I know what I'm going to do. It depends on what the other 9 people ahead of me are going to do because I get the last pick since I won last year.
Oh, so yeah, you're going to be a little behind the 8 ball this season.
Yes, I am. But, it's a long season. We'll see how it goes.
Yeah. Well, very fun. And the Chiefs start things off kind of with a bang down in Brazil. So
that was my next thing that I'm
the other thing you're worried about?
Well, the thing I'm really worried about, and most listeners, I don't know that they would know that I'm a Missouri Tiger since I live on the Kansas side of the state line. They probably think I'm a Jayhawk. But for the first time in, 10, 12 years, Missouri is playing Kansas in football on Saturday. And I have a lot of KU friends that would very happily stick this right in my face if we lose this game. So that has me more nervous than anything is the renewal of the MU-KU rivalry at football.
That's pretty cool. And this college football season got off to a crazy start. And I think every week, is going to have a little bit of a crazy wrinkle to it this season. So
yes.
Hopefully the NFL has some fun chaos in that same way. Except for maybe when it comes to the Chiefs. I don't know. We'll see.
Well, less drama would be better.
There you go. Case. I'm not going to bring up the Travis Kelce and Taylor Swift thing.
Thank you.
Good stuff. Well, you ready to dive into these questions?
Yeah, let's give these a whirl.
All right. I'm sure we've had a few listeners enjoying this back and forth, but a few probably wanting us to get to the meat of the show. And they might identify a similar problem as one of our listener questions here. So we'll find out. By the way, next episode, this, I think, David, in our couple hundred episodes at this point of the podcast, I don't know if we've ever done back-to-back mailbag listener question episodes, but that's what's happening this month. You're getting back-to-back listener episodes, so that's going to be fun.
It will be fun.
First one on the docket. I want to quit my corporate job and start my own business, which would entail some startup costs. Should I take the money from IRAs or get a business loan to fund all this?
So this would have been a really interesting in-office question because this would have taken a very long time to sort through. All I can really do here is give you some of my high-level thoughts on what the questions I would be asking you if we were sitting across the desk from each other. So the first thing that came to my mind is, are you 35 years old or 59 years old? Because if you're 39 and this business maybe doesn't go, you have a lot of time to recover. But if you're 59, it's a lot harder to get a job after you've had a business that didn't go your way when you're 59, 60, 62, and you're close to retirement. So I don't know how old you are, which might lead me to some different questions. But I think my biggest question would be, do you need this business to succeed in order to retire? So if you're 59, that's a really important question. If you're 35, it's not so much of a question. So I did just a quick little research. So I had a Google search, so I'd have a statistic to throw out. But the Commerce Institute tells us that 20% of new businesses fail within the first year, and 49.4, basically half the businesses that get started fail within 5 years. So we don't know what kind of business you're starting. We don't know how much. You say it's going to entail some startup costs. We don't know if that's 10 grand for a laptop and a website, or whether you're talking about $250,000 for some equipment. But your main question was, should I take the money out of the IRA to get the business loan to fund this? What that told me is that you don't really have any non-IRA money or non-qualified monies set aside for your retirement. And my most successful clients have both IRA and 401k money, tax-deferred money, and non-IRA money set aside. So that if they need something like, for instance, starting a business, or something comes up out of the ordinary and they need to go get 20, 30, 40 grand, they don't necessarily want to take extra money out of an IRA because the Uncle Sam gets a nice bite out of that. And you're also sending some tax money to Topeka or Jeff City or wherever you pay your state taxes. So ideally, if you're going to start this business, you don't need it to succeed to retire because you evidently have a perfectly fine corporate job. And ideally, you would not take money out of an IRA, pay 20 or 30% of it in taxes to the IRS and another 4 or 5% to your state, which puts you in an immediate hole. And then, hopefully it's a really, really good idea that brings you a lot of happiness, a lot of success. But if you needed to succeed to retire, then I would want to be really confident in the business that you're getting ready to start up and not be throwing a significant portion of my nest egg at it if I were in my mid to late 50s or 60s.
It's a really good question, and I would imagine that this is one that a lot of people go through, and it may not even just be, okay, IRA or business loan, but there's probably a lot of those things, right? This pot or this pot, this pot or this pot, and that can be concerning when you're that age, closer to retirement, and starting to balance a lot of these back and forth questions of, what are my priorities? You're not close enough maybe to retire and, just pull that trigger, but you've got enough time to maybe still build a business. And I've seen a couple of friends go through this kind of conversation with themselves before. And I know that can be an exciting time, but can also cause a lot of frustration too.
It can. When we're talking about retirement goals with my clients that are maybe mid to late 40s or early 50s, well, and with my kids, we often talk about getting to the point where work is optional. And so perhaps this person asking this question, work has become optional. They don't really need the money. They're all set to retire, but maybe they're late 50s, early 60s, and they're just tired of their boss or tired of the work. And whether this new business starts or fails is not going to impact their retirement. In that case, that could be a really exciting last 5, 6, 8, 10 years of your work life. So it's very situational. I tried to give some ideas for the variety of people that might be thinking about this, but the answer will definitely depend on your situation.
Yep, always that caveat for sure, but another great question from one of our listeners. Thanks for sending that in. By the way, if you would like to submit a question, you can certainly do that to David by going to creativeoneadvisorsgroup.com. We've got that linked in the description of today's show. You can always call as well with your questions, 913-317-1414, and I usually like to say they don't have to be questions that we feature here on the show. You can always just talk these things out one-on-one with David and the team. Again, contact information in the description of today's show if you want to take advantage of that. All right, next question, David. This one is a little longer, so bear with me for a moment. It's got some good details in it. I've been able to live quite comfortably on just my Social Security and pension since retiring last year. However, it just occurred to me that my pension won't adjust each year for inflation. For some reason, I hadn't thought of that before. What should I do with the money in my IRA that I don't need right now, but possibly will need in future years when everything's going to cost more, but my pension hasn't changed?
Yeah, so the fact that your pension doesn't have an inflation cost of living is quite the revelation. Most listeners to this podcast would know that your Social Security does. So that makes your Social Security quite a nice pension plan. So I went back. My immediate thought on this answer was Rule of 72. And that is just a quick down and dirty way to determine how fast will something double in the future. And in this case, how fast will your living expenses double, or in particular, I used it to say, how fast will your pension deteriorate in purchasing power? And here's what I mean. Let's say that inflation is running at 3% for the foreseeable future. You've got a $5,000 a month pension. Rule of 72 says 72 divided by 3, the 3% inflation rate, says that the things that you buy will double in price in 24 years. Another way to look at that is your $5,000 a month pension is going to have purchasing power of only $2,500 a month. It will have been cut in half. So let's say that you are 65 now. So 24 years from now, you'll be 89. So at 89, your pension today is going to have about half the purchasing power that it does today. If inflation runs at, let's just say, 4%, then 72 divided by 4 is 18, or things will double in 18 years. That $5,000 pension per month will be worth $2,500 a month in buying power when you're 83, not 89. So that kind of helps you size up, well, do I need to be concerned about how my IRA is invested? Or it's not really that much of an issue for me. That's a personal question, and we don't know you well enough to answer that question. IRAs, typically you would want, it sounds like, since you're comfortable, that you don't need IRA distributions right away, which tells me that if you have a longer term horizon, you might be able to take a little bit of additional risk in that IRA portfolio. That has to stay in line with your personal risk tolerance. Let's just say that the market goes down 20% next year because we've had quite a little 3-year run and inflation's high, and put your own reasoning behind it. But if the market went down 20% and your IRA was down 15%, would you sell because you're nervous? In that case, you have a moderately low risk tolerance, and you probably don't want to add risk to your IRA. But the ways that you would add risk to IRA to keep up with inflation might include additional allocations to stock market. That could be dividend-paying stocks. That could be tech-related stocks. It could be just the S&P 500. Maybe you add some gold because you don't have any right now. Maybe if your risk tolerance is particularly high, you might add some Bitcoin to it. So I think the key there is to make sure that you are diversified and that you have a relatively high risk tolerance. Anything that you have in bonds, in fixed income, is unlikely to keep up with inflation. I'm not saying it won't, but it's unlikely to. So that's, if you're trying to benefit to stay ahead of inflation, you're probably going to reduce your allocation to money markets and fixed income. The one thing that you didn't really mention in here, and I'll bet you're aware of, so we don't know how old you are, and your pension will continue to fall behind inflation. But at age 73, the government's going to make you start taking money out of your IRA. Now, we don't know how big your IRA is either. But at 73, you're going to have Social Security, pension, and these required minimum distributions. You have to take those out whether you like it or not. Work that into your calculus as well to see, is it worth it to ramp up the risk I have in my IRA when I know that at age 73, I'm going to have to start taking money out of my IRA? That probably more than makes up for the inflation impact of the reducing purchasing power of your pension. I guess what this demonstrates is there are a lot of different ways to look at solving your inflation problem. It's a matter of thinking through them, and based on all of your individual circumstances, age, size of retirement accounts, health, spending patterns, and coming up with a solution that is comfortable and well suited for you. If we can help you with that in any way, we'd be happy to do that. But might be a good time to get a little bit of good advice, especially since this is a new revelation to you about no inflation adjustment to your pension. Either way, best of luck, and I'll bet it's going to work out for you. So you sound like a person who really thinks through things that are coming down the road at you.
It's a really good question. Once again, all you have to do is pick up the phone and give David a call. If you've got questions of your own and want to have a conversation about how to best prepare for your financial future, whether it's talking about retirement broadly or looking at some specifics in your portfolio, or some other question that sparks you to come in and raise that hand for the first time and say, yeah, let's dig into this a little bit. For some people, it's a revelation like this. Oops, I maybe selected something I shouldn't have when it came to my pension. Let's fix this. Or, hey, I want to start my own business, like we talked about a few minutes ago, but I'm not sure where to pull the funds from. I've got funds, but I don't know where's the best place to pull them from and what are the consequences. These are the kinds of things that David and his team are talking out with people in the office each and every day. So don't hesitate if you've got questions like this to reach out. You can do it by going to creativeoneadvisorsgroup.com or by calling 913-317-1414. David, thanks for all these details. Good luck to the Chiefs. Good luck in your fantasy draft. And we'll have some more listener questions queued up next time around.
I will look forward to that. These are my favorite topics, so hopefully some good stuff next time as well.
Excellent. Well, come back and join us for that, folks. We'll see you again right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth LLC, a registered investment advisor, Creative One Securities LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.